Welcome to Wealth Echelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your money. For decades, financial advisors have leaned on the 4% rule as the gold standard for retirement planning. Developed in the 1990s by financial planner William Bengen, the rule suggests that retirees can safely withdraw 4% of their retirement portfolio each year without running out of money over a 30-year retirement. While this guideline has served as a reliable benchmark for traditional planning, it's increasingly being questioned in a world of low interest rates, rising inflation, unpredictable market cycles, and increased life expectancy. In today's rapidly shifting economic landscape, relying solely on the 4% rule may no longer be sufficient or safe. Instead, investors are turning to a strategy that prioritizes income generation through high-quality, high-yield dividend portfolios. The idea is simple but powerful. Build a portfolio that generates 8% in annual income through dividends alone. This approach not only covers your financial needs without touching the principal, but also opens the door for long-term portfolio growth, reinvestment, and real financial independence. Let's explore why this 8% dividend strategy is emerging as a smarter, safer option, and how it stacks up against the traditional 4% withdrawal model. The problem with the 4% rule in today's economy. The 4% rule was created during a time when bond yields were higher, markets were less volatile, and inflation was more predictable. It was designed based on historical backtesting, assuming a 60-40 stocks to bonds portfolio. But we're no longer living in that world. In recent years, bond yields have plunged, stocks have become more volatile, and inflation has eaten away at purchasing power. More importantly, the 4% rule assumes you'll be depleting your nest egg over time. That means your retirement portfolio is on a slow decline towards zero, a concept that makes many investors uncomfortable, especially in uncertain times. It also offers little flexibility for unexpected life expenses, market downturns, or longer than expected retirements. In contrast, an income-first strategy built on dividends shifts the entire equation. Rather than drawing down your capital, you generate cash flow from assets that continue to grow. That's the heart of the 8% dividend approach, and it flips the traditional retirement mindset on its head. The power of an 8% dividend strategy. An 8% dividend yield means that a $1 million portfolio could produce $80,000 per year in income without selling a single share. That's $6,667 per month, coming in regardless of market performance. If managed correctly, this income can cover living expenses, healthcare, travel, and more, while allowing the original capital to remain invested and even grow. More than just numbers, this strategy provides psychological security. It eliminates the fear of running out of money and reduces the emotional strain of watching your portfolio shrink in a down market. You don't need to worry about timing the market, selling off assets at a loss, or recalculating withdrawals every year. The income is steady, predictable, and in many cases, tax efficient. Of course, not all 8% yields are created equal. The key is building a portfolio of reliable dividend payers that also have strong balance sheets, competitive advantages, and the ability to sustain or grow their payouts over time. This can include high-yield ETFs, REITs, covered call strategies, business development companies, BDCs, and select blue-chip dividend stocks. Capital preservation and portfolio longevity. One of the most attractive features of this strategy is that it preserves your capital base. Under the 4% rule, you're expected to draw down your portfolio over 30 years. But what if you live longer? Or what if markets crash early in retirement, triggering the dreaded sequence of returns risk? With an 8% dividend approach, you're not selling assets. You're collecting income. Your principal remains intact, and in many cases, it can grow through appreciation or reinvested dividends. Even if part of the dividend yield is supplemented by option premiums or alternative strategies, such as in covered call ETFs. The idea is that your withdrawals are fully funded by income, not capital erosion. This not only extends the life of your portfolio, it can make it essentially infinite. If you're not depleting the principal, you're not on a countdown. You're building a sustainable, self-sufficient ecosystem that generates income indefinitely. Reinvesting for accelerated growth. Another major benefit of this approach is the power of reinvestment. If you don't need the full 8% for expenses, you can reinvest part or all of the income to accelerate your portfolio's growth. For example, reinvesting even 25 to 50% of your annual dividends can add hundreds of thousands of dollars to your portfolio over a decade. Let's say you only spend $50,000 of the $80,000 you earn in dividends each year. Reinvesting the remaining $30,000 could dramatically compound your total wealth, especially if done consistently through market ups and downs. Over time, this strategy doesn't just maintain your wealth, it increases it. The best part? Your income grows with it. As your portfolio expands, your 8% yield is based on a larger base, which means your cash flow grows as well. That's a far cry from the 4% rule, which only shrinks over time as capital is withdrawn. Diversification and risk management. A common criticism of high-yield investing is the perceived risk. While it's true that chasing high yields can lead to exposure to unstable companies or sectors, a properly constructed dividend portfolio can actually reduce risk. The goal isn't to blindly pursue the highest yield, but to identify sustainable income sources from well-managed companies and funds. That's where diversification comes in. A portfolio that includes a mix of dividend growth stocks, which consistently raise payouts, high-yield ETFs, such as those focused on covered calls or real estate, utilities and infrastructure, known for stable, regulated cash flows, real estate investment trusts and business development companies, which are legally required to distribute most of their earnings, preferred shares or fixed income hybrids, can spread risk across sectors and market conditions. It's not about betting on one income source. It's about building a cash flow ecosystem where no single asset makes or breaks your financial future. Growth meets income, the best of both worlds. Many investors assume they have to choose between growth and income, but a smart 8% dividend strategy aims to do both. By including assets that offer capital appreciation potential along with income, such as dividend-paying tech stocks, growth-focused REITs, and ETFs with covered call overlays, you don't sacrifice growth just for yield. This is especially important in today's environment. Inflation is eating away at cash savings, and relying solely on fixed income won't cut it anymore. A strategy that generates strong income and grows over time is essential for preserving purchasing power and adapting to future economic shifts. In fact, many dividend-focused ETFs have delivered total returns, price appreciation plus dividends, that rival or exceed the S&P 500 over 10-plus years. When chosen carefully, income assets can be just as powerful as growth stocks, without the roller coaster volatility. A $1 million 8% dividend portfolio. Let's break it down in numbers. Imagine a portfolio composed of a strategic mix of high-yield dividend ETFs, blue-chip stocks, and income-generating funds, yielding a blended 8% annually. Here's what that might look like. $1 million times 8% equals $80,000 annual income. $6,667 monthly income. Fully passive. Reinvesting even 25% of that, $20,000 annually, could lead to portfolio growth of $300,000 to $400,000 over 10 years, depending on returns. And the beauty of this setup? Your capital remains intact. You're not drawing down your assets. You're simply harvesting the income they naturally produce. That's not just safe, it's sustainable. Beyond numbers, this strategy has a profound psychological impact. It gives you freedom. Knowing that you don't need to sell investments to pay the bills removes the anxiety of market timing. You become less reactive, more long-term focused, and more confident in your financial path. It also gives you flexibility. You can choose to spend, reinvest, or gift your income. You can adjust for inflation, unexpected expenses, or opportunities. Unlike the 4% rule, which locks you into a linear withdrawal model, This strategy evolves with you. And when you stop thinking of retirement as decumulation and start seeing it as financial independence, the entire game changes. You're not running out of money. You're creating a permanent income machine. A smarter, safer future, extended. The 4% rule isn't just outdated, it's outmatched. It was built in a time when the economic environment was more predictable, when retirements were shorter, and when bonds offered decent yields. But today's retiree faces a very different world. Interest rates swing wildly. Market downturns are sharper and more frequent. Healthcare costs are soaring. And with people living longer than ever, retirement now spans 30 to 40 years, not 20. The math simply doesn't hold up anymore. That's why income-focused investing is no longer just an alternative. It's becoming a necessity. An 8% dividend strategy shifts the retirement conversation away from depletion and toward preservation and regeneration. It's a strategy built for resilience. When you generate consistent income from your portfolio, you stop relying on market performance to fund your life. You start building wealth from cash flow, not capital liquidation. And that distinction is powerful. Imagine being retired, not worried about whether the market is up or down, but knowing that every month your portfolio is depositing income into your account. That's peace of mind. That's financial independence. You're not making emotional decisions. You're not timing the market. You're living confidently, knowing your money is working for you 24/7. What's more, this strategy gives you something the 4% rule never could. Options. Want to take a spontaneous vacation? The income is there. Need to cover unexpected medical bills? The income is there. Want to help your kids with a down payment or gift a legacy to your grandkids? You can do it without fear of running out. Because when your capital is preserved and your income is growing, your future is flexible. This approach also recognizes that retirement isn't the end of growth. It's a new phase of it. A portfolio that delivers 8% income can also grow in value, especially if some dividends are reinvested. This isn't just about surviving retirement. It's about thriving in it, continuing to build wealth, and potentially leaving behind more than you started with. And the benefits don't stop at personal gain. A sustainable dividend strategy empowers you to give more, do more, and live more without compromise. It aligns with the values of long-term stewardship, security, and self-reliance. It's not a flashy speculative play. It's a rock-solid foundation. In this new financial age, we need new tools and new mindsets. The old rules were built for a slower world. This one moves faster, costs more, and demands better planning. But with the right strategy, one that pays you consistently, protects your core assets, and gives you room to grow, you can meet it head on. So if you're still following the old script, maybe it's time to turn the page. Because the next chapter of wealth building doesn't start with fear. It starts with smarter systems, sustainable income, and a strategy that works with the future, not against it. This is more than investing. This is designing a life where you don't outlive your money outlives you. At WealthEchelon, we're not here for hype. We're here to uncover real innovation, challenge the noise, and keep you ahead of the curve. If you found value in today's breakdown, make sure to like, subscribe, and hit that notification bell so you never miss an opportunity to decode the future of investing. Got thoughts on this project? Think it's revolutionary or overrated? Drop your take in the comments below. Let's keep the conversation going. Until next time, stay curious, stay sharp, and keep it investing. This is WealthEchelon, signing off.